Okay, let's go ahead and get started. Again, good afternoon and welcome to today's educational webinar on covered calls. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay. And today I am going to be going over my thoughts on covered calls and how to best implement this strategy. This is a very powerful income generating strategy. And in my opinion, it also provides you with the best of both worlds, maximizing your longer term portfolio holdings while also being able to generate additional yield. So very excited to get going with this topic. And it's part of a bigger series as well of income webinars that we will be doing over the next few weeks. The next webinar would be cash secured puts, and following from that would be the wheel strategy itself, which is really an amalgamation of covered calls and cash secured puts. So really this first part of a three-part series. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only. Examples do not include any commissions or fees. So our agenda for today, we'll be starting off with an overview of the wheel strategy. Like I said, this is essentially what we are building towards. So the wheel strategy is an amalgamation of the covered call strategy, which is what we're going to be covering today, as well as cash secured puts, which is what we will be covering in 2 weeks' time. Starting off from there with what is a covered call, the basics of a covered call, quite a simple strategy in terms of what's in it. But when it comes to, going over an example, you'll be able to see what the best practices are for covered call and also the optimal setup for covered call. This is really the most important part for today's webinar, finding the optimal covered call, because it's really what makes or breaks this strategy. Yes, it's a powerful strategy when used correctly. From there, we'll be moving on to covered call scenarios. So taking a look at the overall trade management of a covered call, what happens when the underlying stock rallies, what happens when it moves sideways, and what happens when it declines. And finally, we'll then quickly cover OptionsPlay's and First Trade's tools for covered calls that we offer for you. So the main question that I want to help you answer today is, how can I generate a consistent additional yield on a portfolio using options? So that's why I say the covered call is a very powerful strategy, because it allows you to generate a consistent stream of income in addition to your portfolio holdings, in addition to dividends, and in addition to capital appreciation of your actual stock holdings. So when it comes to the covered call, there are prerequisites to it, such as actually owning the underlying stock. But you can almost think of it as, an additional income stream, similar to what dividends are. When you own the stock, you get dividends. And when you own the stock, you can also start selling covered calls as long as you own enough shares. So before we get onto that, let's take a step back and let's take a look at our overall plan over the next few weeks. And that is really the wheel strategy. So the wheel strategy is a very powerful income generating strategy, as well as a stock acquisition strategy. So this is a strategy that helps you generate a continuous stream of income. It helps you purchase stock at a discount. And in doing so, since you own the underlying stock, you get to participate in the capital appreciation of that stock. So if the stock continues to rally, you get to participate in that while also consistently generating an additional stream of income, no matter what market conditions are in play. So on the right-hand side, we have this diagram of essentially the entire wheel strategy. And the parts in the green are the two main components of the strategy. On the top, we have the cash secured put section, which is something that we will be covering in 2 weeks' time. But basically, a cash secured put that allows you to get assigned to actually buy the underlying stock. That's how this part is the top part is a stock acquisition strategy. So that helps you acquire the stock at a discount while generating a continuous stream of income. Now, once you actually own the stock, from there you can start selling covered calls. So by selling a call option on that stock, so using that as collateral, you collect a premium. And that is the continuous income stream, because this is essentially a rinse and repeat strategy. There are two outcomes to this. So the first outcome is that the call option expires worthless. So the underlying stock does not reach the strike price of the call option that you sold, and you get to keep that full premium and simply sell another covered call, hence the rinse and repeat characteristic of the strategy. Now, the second option, or the second outcome that can happen is that you get assigned. So that underlying stock actually does rally to the strike price of the call option that you sold. And in this case, because it's a call and you're obligated to sell the stock at the strike price, if you get assigned, you will have to sell the stock. And many people view this as a negative outcome. I tend to view this more as a positive outcome, depending on the circumstances, because when you play, how do I put it when you use the optimal covered call, it allows you to maximize the capital appreciation of that stock. And that should always be the priority. Yes, generating a continuous stream of income on stock that you own for the long term is always nice. But at the end of the day, you own the stock because you believe it's going to move higher. Now, using the covered call strategy, it allows you to actually sell that stock. And when used correctly, it allows you to sell it after a very strong rally, really maximizing the rally. So don't view the assignments process as a negative outcome. In many cases, it's actually a positive outcome where you get to sell after a lot of momentum in the stock and move on to the next opportunity. So going back to basics, over here we have a T chart of our 4 basic strategies. We have the top section are the bullish strategies with long calls and short puts. The bottom section are the bearish strategies with short calls and long puts. Now, the covered call is really a one-legged strategy when you're looking at it from an options perspective, because all you do is you sell a call option, but it has to be on stock that you already own. So it is technically a multi-leg strategy, but for an options perspective, it is only one option that's involved, and that is selling a call option. So once you short a call option, you receive a premium, but you're obligated to sell the underlying shares if you get assigned. Remember, you are the passenger in the strategy, you are not the driver. So you don't control whether you get assigned or not. You can close out your position before you get assigned, but if you get assigned, you will have to sell those underlying shares at that strike price. Now, this is technically a bearish strategy, because when you sell a naked call option, you want the price of the underlying to move lower so you don't get assigned. And so that the value of the call option reduces, so you can buy to close for a price that is lower than you sold to open it for, or just simply expires worthless and you keep your full premium. However, the covered call strategy is actually a bullish strategy, because you are still long 100 shares of the underlying, and because of that, you want the shares to move higher, and you should always prioritize the capital appreciation, because the capital appreciation will always make more than the income received. The income received is more of a cherry on top of the cake. It's just an additional yield. That's how you want to view it. You don't want to sacrifice your long stock holding for the sake of simply receiving small income. Always prioritize capital appreciation. That is the #1 mistake I see people make when using the covered call strategy. So what is a covered call? I'm pretty sure, the last few minutes I mentioned quite a bit of what it was already, but a covered call does require one prerequisite, and that is to own 100 shares of an optionable stock or an ETF. So you have to own at least 100 shares of a stock or an ETF that you want to sell a covered call on. From there, you sell a call option, and you use that stock or the ETF as collateral, and therefore you receive a premium in doing so. Now, this creates an obligation to sell the stock or the ETF at a specific price or the strike price. As you can see on the P&L, the P&L diagram on the right-hand side, this is a bullish strategy. So the further right the underlying moves, the more this becomes profitable up to a certain point. And that certain point is the strike price. So you still have bullish exposure on the underlying shares for the covered call strategy up until the strike price, but you don't have any exposure above the strike price. So if you sold a call option with a strike price of 110, and let's say the current price was at 100, it managed to rally all the way to 115, you only make profit on 110 because you're selling your shares at 110, even though that current price is 115. So that is a downside of a covered call. But it's still a positive outcome. At the end of the day, chances are you bought this, below 110, and therefore you have still made a profit on the stock leg of the strategy. In addition, you still receive that premium. Now, when it comes to the loss potential, yes, it's quite substantial, as the diagram says. The only reason being is that you're long 100 shares. Now, those shares could theoretically move to zero, and that is why there is significant loss potential. But if the underlying moves sideways or even lower, your exposure is only the stock side of the trade. It's not the call option side of the trade, because the call option will reduce in value, which is working in favor of the call option, because you are short the call, and therefore you want it to reduce in value and depreciate, so you can buy to close at a later date for less than you opened it for, than you sold to open it for, or it simply expires worthless. But it doesn't make you immune to the loss potential of the underlying shares. So I want to look at this through the eyes of a stock investor versus a stock and options investor. Now, starting off with a stock investor, what we have here is a chart of Apple from this morning, currently trading at, for simplicity's sake, 165 on the dot. Now, as a stock investor, let's say, I have a bullish view on Apple, and therefore I am going to simply buy these shares. I expect Apple to rally, and, all the way to potentially 165. So I think I might have my order mixed up here. Sorry, 175. Yeah, so what does this mean? I would buy 100 shares of Apple at 165. My price target is 175. And therefore, I would place a sell, after buying this 100 shares of Apple, I'll place a sell limit on Apple at 175. This means that my risk is $165 a share. Naturally, if Apple moves to zero, I'll be losing 165 in total. My reward is $10 a share, 175 minus 165. And in terms of my exposure, I get to collect dividends, and I'm exposed until Apple reaches that 175 level. Now, that is still, that's a pretty good outcome. I make a potential reward of $10 per share if I am correct in my thesis. Now, let's look at this through the lens of a stock and an options investor. In this case, I'll do the same thing. I'm going to buy Apple at the same price of 165. Now, my price target, again, is still 175. So I am expecting a rally. But after buying the shares, what I decide to do is I sell a call option with a strike price of 175. And I receive $2 in premium for doing so. This is just an example, but I received $2 in premium for doing so. Now, straight away, this skews the risk to reward in your favor. When it comes to the risk, from 165 a share, you are now only risking $163 a share. Not a huge difference, but remember what I said, you rinse and repeat the strategy, so you're consistently reducing your maximum risk of those underlying shares moving to zero. When it comes to your reward, that has now increased to $12 a share. This is because your cost basis, after receiving that premium of $2, that means you essentially bought Apple for 163, right? So you're using that premium to offset your initial stock purchase amount. So your reward increases to $12 a share because your price target is still 175, and 175 minus 163 is 12. And your exposure, well, you generate $2 a month also in premium by rinsing and repeating the strategy. And you also still get to collect dividends until Apple reaches 175. So in addition to dividends, by selling call options or covered call on your underlying shares, you generate additional yield. Now, when it comes to finding the optimal covered call, and this is the most important part of today's webinar, this is where, like I said, it can really make or break this strategy. So we're going to keep consistent with Apple and using the same example of Apple trading at, let's say, 165. And when it comes to finding the optimal covered call, there's two variables that you have to think about: the expiration date, how far out should the expiration be, and the strike price. What strike price are you willing to sell your shares at? Now, we've done a lot of the heavy lifting for you at OptionsPlay, and we've done a significant back test from 2008 all the way to 2022 to figure out over the long term what were the best strike prices and expiration dates for the covered call strategy, and what generated consistent returns. Now, I can tell you right now that the optimal expiration was 45 days. So this over the long term just helped generate a good revenue stream, helped generate enough premium, but also had enough time decay working in your favor. If you go further out from 45 days, let's say 90 days, you generate a bit more premium, yes, but the time decay hasn't really started to kick in. The value of the option will still stay, quite neutral, all things considered, and you don't have the time decay working as much in your favor. Now, if we go all the way to the other side, and let's say you sell, call options with 5 days to expiration, you receive less premium, but you have a lot more time decay working in your favor. And that's not that may seem quite tempting, but eventually when you do get assigned, you'll find that you haven't generated enough premium to offset that risk of getting assigned. Whereas if you stick to 45 days, not only does it give you more time to potentially close out the position before getting assigned, but you generate that bit more premium. The other thing that I forgot to mention actually was with regards to the 45 days to expiration. Another way of thinking about this is compared to, if you're maybe tempted to sell further out of date call option, let's say, for example, 90 days, you'll actually receive more premium by selling 2 45-day call options, 45 days and then let that expire and then selling another 45-day, as opposed to selling one 90-day. So you are trading a little bit more frequently, but you receive more premium, and that is due to theta acceleration that only kicks in closer to the expiration of the option. Now, when it comes to the strike price, this is where things get a little bit more tricky, but it's still quite simple. What we have here are 3 different strike prices. We have the 180 strike. This collects 97 cents per share in premium, or $97 in total. Remember, we are dealing with 100 shares. This represents a raw return of 0.6%, which is a premium received compared to the price of Apple. Now, if you look at this as an annualized figure, as an annualized return, all that is a raw return over a 12-month period. So if we were to rinse and repeat the strategy with the exact same premium received and raw return, every 45 days for a period of 1 year, I will get 5.09% annualized. Now, most importantly, this is the 15 delta strike. Sorry, this is the 15 delta strike. Now, the 15 delta strike, I'm sure many of you do know the definition of delta, which is the price, the change in the option price relative to the change in the underlying. However, it also represents a probability of that strike price getting hit. So this tells me that there's a 15% probability of Apple reaching 180 within the lifetime of this option contract. Now, just keep that in mind, and let's go over the other 2 strikes as well that we have. We have the 175 strike, which is the 25 delta, so a slightly higher probability of that price being hit, naturally so, because it's a lot closer to where Apple currently is trading at, but it collects a lot more premium. It collects $2 in premium, raw return of 1.26, and annualized return of just under 11%. So you get a lot more premium received for selling a higher delta and a strike price that is a little bit closer to where Apple is currently trading at. And finally, we have the 40 delta, so a 40% probability of this price being hit at 170. This collects a lot more premium again, at $3.80 and a high raw return of 2.4%, annualized to 21.6%. So the lower the delta, the higher the premium received, as you can see, and that is a trade-off, right? The higher the probability of getting assigned, the higher the premium received. There's a higher risk to this trade. Now, I want to conduct a quick thought experiment here using the chat window. Which strike price do you think is the most optimal for a covered call? Is it the 15 delta, 25 delta, or the 40 delta? Please just use the chat window. So I realized that the chat window was disabled. I've just enabled it now. So the 15 delta, 25 delta, or 40 delta. Yeah, I see a few 15 deltas, 25 deltas. Okay, quite interesting here. So fairly mixed response between 25 and 15 delta. No one actually went for the 40 delta, which is surprising considering that it generates the most premium. And for those of you that said 15 delta, well done. That's the correct answer, or the correct range. And the reason for that is because, yes, it collects a whole lot less premium. It only collects 97 cents per share compared to, you know, the 25 delta that doubles that, the 40 delta that's almost 4 times as much. However, remember what I said earlier, you always want to prioritize capital appreciation. So if I were to sell my shares at 180, I am making an extra $10 a share, or another $1,000 in total, compared to selling my shares at 170. Yes, I'm generating just about $2, let's say $2 more in premium, but I'm foregoing that additional capital appreciation in doing so. So I'll be generating $10 more in capital appreciation, but foregoing that $2 extra in premium compared to if I sold that 40 delta. So there's a huge gap there of capital appreciation that we'd be missing out on if we sold at 40 delta, even though it collects more premium. So always go on the conservative side when it comes to selling a covered call, unless you really want to get rid of your shares. You know, there's always going to be exceptions to the rule, but our best practice is 45 days and 15 delta, or 10 to 15 delta even. And even though it collects a little bit less premium, you have a less probability of being assigned. And if you do get assigned, think about this, right? If you do get assigned in 45 days of Apple rallies all the way to 180, chances are it's overbought. Chances are it's going to reverse a little bit lower over the next few days or few weeks. And therefore, by selling the 15 delta, and even by getting assigned, you're essentially selling or forced to sell at a market top, or at an overbought condition, which is ideally the best time you'd want to sell those shares anyway. Okay, so let's take a look at some scenarios. Let's say, for example, you know, you sold a covered call and the underlying stock starts to rally. So this is when people tend to panic, right? You think assignment, I am going to get assigned. What do I do? Do I close, or do I just do I close my position, buy to close for a huge loss, or do I just hold? And our best practice, and you know, in my personal experience as well, is to actually hold that position, especially if you see a rally that happens in the first few days after selling a covered call. Hold that position and roll 1 to 2 weeks on that expiration date. The reason I say hold the position is, like I said, if there's a strong rally right away, chances are it's going to be approaching an overbought condition very quickly, and chances are, more often than not, you'll tend to see price pull back closer to the strike price, or even back below that strike price. And it stops you from, you know, panicking and buying to close a little bit too early when the option is very expensive. So you still have time decay working in your favor. It helps reduce the overall cost of that option. So even if you do have to take in a small loss by buying to close, the time decay element will be working in your favor, and it's better to take that loss, you know, later rather than earlier, thanks to time decay. Now, when it comes to rolling 1 to 2 weeks on that expiration date, this is where you simply simultaneously buy to close the call option and you sell to open a new one with a new expiration date and a new strike price using the exact same best practices that we discussed in the previous slide of 45 days to expiration and around 15 delta. So you'd still, when you roll, you still use the optimal setup, but you're just simply closing a previous one and simultaneously opening a new covered call. Rolling too early would lock in a loss on that covered call. And again, be happy if your stock is called away. You probably made a nice profit on your stock, especially if you bought Apple, let's say at 150 or something, and you're selling it at 170. Yes, getting rid of the shares, but that's still a very solid return on capital. Now, what happens if the underlying starts to trade sideways? And this, in my opinion, is probably the more optimal outcome. Yes, covered calls are technically still a limited bullish strategy, but it's less stressful when the underlying trades sideways. All you have to do here is hold your position, and you can roll once you've made 75% of max reward. So if I sold a call option for $1 per share, or 100 in total, and let's say markets have been neutral, Apple hasn't really moved much, and that time decay has eroded the option value all the way down to 25 cents from $1. From there, I can think about rolling. So I'd buy to close to 25 cents and I'd sell to open again another call option with the 45-day rule, with the 15 delta rule, and generate more premium. The reason you do that is because even though there's accelerated time decay, but that extra 25 cents, you'll have to wait all the way up until expiration to really realize that profit. Whereas if you roll that, yes, you are foregoing that 25 cents, but it helps to quickly generate even more premium by selling a new call option with more theta. Now, no harm in holding calls till expiration as well. So if you aren't comfortable with rolling the option right away, or let's say there's an earnings announcement and you don't really want to have you don't want to have short call exposure during that, there's no harm in holding calls to expiration because you still get to keep that full premium. And again, remember to sell another covered call the following Monday after option expiration Friday. Now, let's say, for example, the stock declines, and many people view this as a positive outcome because they won't get assigned, but I don't really view it as a positive outcome. Again, it comes down to the fact that you have to prioritize capital appreciation. You're buying shares or you're buying the stock so it actually appreciates in value. And the fact that it declines, it's good for the call option, as in you won't get assigned, but your overall position will still be in the red even after the premium received. But the premium received does help soften the blow. So in this case, you'd roll down your covered call early. So you would buy to close at 20% or so of the original premium. So selling a $1 covered call, I would buy to close when it's worth 20 cents. And I'd sell a new covered call or new call option with 45 days to expiration and 15 delta. The reason you do that is because if the stock does decline, your covered call or your call option will reduce in value quite quickly. And you don't want to wait all the way until expiration for the remaining 20 cents worth of premium. Instead, you want to lock in that profit and help generate even more premium. Now, do not let these go to expiration. Like I said, lock in the gain and collect more premium. And the most important thing here is that you want to ask yourself, do I still want to remain invested in the stock? At the end of the day, it has declined, or do I want to just get rid of it now and sell it? Okay, so OptionsPlay in partnership with First Trade have developed a covered call report for all First Trade members to use. And this covered call report scans all the S&P 500 stocks as well as very liquid ETFs. This is updated hourly, and it helps you find optimal opportunities with the highest yield. It uses our best practices as well. So just to actually show that to you here, what I have here is the covered call report. All you have to do is click on research and tools, click on options, and it'll take you to this page and click on the covered call report. So what you can see here is a list of a whole bunch of different symbols. This is sorted by the raw return, but you can choose other ways. Oh no, actually, maybe not on this one, but you can play around with that as well. So with the covered call report, again, it is based on our best practices. You have the expiration date, the strike price. You have the mid price, which is the price between the bid and the ask. It's the most competitive price that we recommend. You have the IB rank, which gives an indication as to how high the implied volatility is. It's not a make or break variable, but it's always good to know when you're selling an option, how much bang for your buck that you're getting. Implied volatility plays a huge part in the options pricing formula. And when implied volatility is high, we tend to see option prices are high as well. So implied IB rank just gives a number between 0 and 100. And it compares the current implied volatility over the last year. So, a higher IB rank would mean that that stock compared to itself has a lot more implied volatility throughout compared to the last 1 year or so. Now we have the earnings date and the earnings flag. Earnings flag is simply a yes/no variable that will be either yes if there is an earnings date within the lifetime of the contract, or no if there is no earnings date within that lifetime. Days to expiration, raw return, annualized return, as discussed before. And my favorite column, distance to strike. So distance to strike tells us how much that underlying stock needs to rally to reach that strike price. The other thing that you can also do here is click on the trade button, and this will automatically populate a ticket here, an order entry form for you. So with that, that is what I have for you today. And I'd like to open the floor to some questions. I do have a couple of minutes to answer some questions, but please use the Q&A window for that. So how do you roll an option? By rolling an option, you simply are buying to close, or not buying to close, but you're closing an option and you're selling to open a new one. Now, most platforms will allow you to do this as one transaction. So that is what rolling is simply buying to close or selling to close, and buying to open or selling to open a new option. If there are no more additional questions, with that, thank you so much, everyone. And I will see you next week for a Tuesday market outlook. I hope you all have a great trading week and a good Friday.